Hello everyone, and welcome to Income Ideas Expert. Today, we're delving into a MACD strategy that boasts remarkable accuracy, making it essential knowledge for both Forex and stock traders. This MACD strategy I'm about to discuss is among the most effective trading approaches, offering a significant success rate. It's user-friendly, applicable to nearly every market, and, most importantly, it consistently generates profits. So, without delay, let's jump right into it. MACD, or Moving Average Convergence Divergence, ranks as one of the most commonly employed technical indicators in the trading world. Among traders, this indicator is a popular choice. Essentially, it leverages moving averages to pinpoint market trends, and it excels at this task. Now, if you've been in the trading game for a while, you've probably encountered or even used the MACD indicator. However, it's important to note that relying solely on the MACD indicator is not the most effective approach. That's why it's vital to stick around for the entire video to see how I combine it with other indicators to substantially boost its performance. To kick things off, let's start by incorporating the MACD. When we add the MACD indicator to our chart, it proves exceptionally proficient at recognizing market trends. To identify an upward trend on the chart, we must pay close attention to the MACD line crossing over the signal line. For instance, when the MACD line moves above the signal line, it signifies an upward momentum, whereas a cross below the signal line indicates a downward momentum. Additionally, we can assess the strength of the momentum by examining the histogram. A growing histogram signals an increasing momentum, while a diminishing histogram signifies a decrease. To optimize the effectiveness of this indicator in momentum trading, it's recommended to initiate a trade when the lines cross upward, specifically below the zero line. It's not advisable to enter a trade when the lines cross above the zero line. Similarly, for short trades, it's critical to enter the market only when the lines are crossing downward and positioned above the zero line. As you can see, this indicator is user-friendly and easy to grasp. However, many traders encounter challenges when solely relying on this indicator. Let me explain why this approach may fall short. The MACD indicator works exceptionally well when the market follows a clear trend. For instance, in this scenario, the MACD indicator accurately anticipates upward price movements, aligning with an upward trend on the chart. However, in certain situations, despite the price declining, the MACD still signals a long trade. This highlights that the MACD alone may not be sufficient for trading, emphasizing the importance of implementing filters to avoid potentially costly errors. In the next section, we'll delve into the most effective filter strategies. There are proven methods to safeguard traders from falling into the MACD trap. Here's a straightforward technique for determining whether the market is in an uptrend or downtrend. Add a 200-day moving average. Once this indicator is incorporated, you'll see a single line on the chart. When the price is positioned above this line, it indicates an uptrend in the market. Conversely, when the price is below this line, it signifies a downtrend. So, if the market is above the 200 EMA, you should focus on buy signals. If it's below the 200 EMA, you should concentrate on sell signals. Let me illustrate how this EMA line accurately identifies whether the market is bullish or bearish. As shown here, when the market is below the black 200 EMA line, it tends to continue moving downward. It often attempts to go even lower than the line. After exhausting its downward movement, it starts to rise and breaks above the black 200 EMA line. Once it successfully breaks above this line with the price positioned above the 200 EMA, the market tends to become bullish. Now, what makes this line special? Institutional traders, including banks and fund managers, pay significant attention to this 200 EMA line. Many of their financial decisions are influenced by it because they share a common understanding of its significance. Predicting the effects of their financial decisions becomes more manageable. In the next part, I will explain how to maximize your profits by combining MACD with the 200 EMA. In the market, when we bring all these elements together, we execute a buy trade when the MACD lines cross below the zero line, while the current price remains above the 200-day moving average. This method ensures that you only trade when the market is in an uptrend. On the other hand, for entering a short trade, you do the opposite, confirming that the price is below the 200-day average and the MACD lines are crossing downward while positioned above the zero line. To illustrate, let's consider initiating a long trade at this point. We commence the trade because the MACD lines are crossing upward below the zero line and the current price remains above the 200-day moving average. What I like to do is set a stop loss just below the 200-day moving average. This way, the 200-day moving average acts as a support level that the price must breach to hit my stop loss. Additionally, I prefer to set a profit target that provides a 1-to-5 ratio in relation to the initial risk. As seen in this example, the strategy functions precisely as intended, resulting in profitable outcomes. Now, I'll reveal the most crucial secret that ensures maximum profits. Depending on the profit-taking strategy you employ, the true strength of this approach lies in placing your trades in close proximity to the 200 EMA. As I mentioned earlier, when the price gets near the 200 EMA, if it bounces back, the potential gains will be significantly higher. With the potential risk-reward ratio potentially exceeding 1-to-5, it's crucial to maintain a vigilant watch on the market, akin to a sniper. Keep an eye on the price as it approaches the 200 EMA zone. If it bounces back, you have the potential to accumulate wealth swiftly. While this technique is highly profitable, it's of utmost importance to consistently apply stringent risk management practices. However, we can further enhance this trading strategy. While the combination of MACD and the 200-day moving average is highly effective during substantial price movements, it becomes less reliable and generates false signals when the chart enters a sideways phase and loses momentum. Take this example, for instance, where the chart moves sideways and the MACD produces numerous false signals. If you had traded at this point, you might have incurred losses. To address this issue, avoid the market if the 200 EMA is clearly horizontal and the previous market movement is challenging to decipher. Enter the market only when the trend is significantly clear. When the slope is discernible and the market trend movement is easy to interpret, I've just introduced you to a highly potent blend of MACD and the 200 EMA, leading to remarkable success rates. As evident in these examples, nearly all trading signals result in substantial profits. You can manually establish a trading system based on this strategy. Thank you for tuning into this video on MACD trading strategies. I hope you found the information here useful and insightful. Remember, successful trading involves a combination of knowledge, practice, and discipline. If you enjoyed this content, don't forget to hit that like button and subscribe for more valuable insights. If you have any questions or want to share your own experiences with MACD trading, feel free to leave a comment below. Your feedback is highly appreciated, and I'm here to assist with any queries you may have. Stay tuned for more exciting content on trading and financial strategies.